Hello everyone, this is Charlie from Altcoin Mentors. Is your long-term portfolio completely wrecked after this recent crypto downturn? Well, watch this video and find out how you can make sure to never let that happen again, and all without ever selling your long-term investments. For the best investment and trading advice in all of cryptocurrency, make sure you subscribe to our channel and hit the bell to be notified every time we post a new video. If you don't want to sell any of your long-term investments, but think that there's still some downside to come in the market, by the end of this video, you'll know exactly how to hedge your investments with limited counterparty risk and protecting you against further downside, all with favorable tax ramifications. We've personally used this strategy to keep our portfolios near their all-time highs for the past few months. About a month ago, when the market was really tanking, I posted in our Telegram channel that I was hedged to beta neutral. And I got a lot of questions about what that was, what it meant, and how I was doing it. Hedging is when you open a new position that has a negative correlation to the investments that you're hedging against. In other words, this new position will generally move opposite to your investments, protecting you against further downside in the market. In stocks, there are many different ways to hedge, including various option plays, going short a stock in the same sector, going short the entire sector, or even the entire market. But in crypto, the primary way that we're going to hedge is by going short Bitcoin futures. And I'm going to show you exactly how to do that later on in this video. There are three primary reasons why you'd want to hedge your investments instead of selling them. The first is for tax purposes. If you sell your investment less than 1 year after you purchased it, the profits are going to be taxed with a short-term capital gains tax instead of the long-term capital gains tax. Now, this is going to end up costing you anywhere between 12 and 20%, depending on your tax bracket. And so if you have an investment that you haven't yet held for 1 year, if you hedge that instead of sell it, you'll be able to take advantage of those savings, which can add up to a very substantial amount over time. The second reason is when it's simply inconvenient for you to sell. If you follow good security practices, you have your coins spread across different hardware and paper wallets. It would be incredibly time consuming for you to get your coins from each of those wallets, send it to exchanges, and then sell it. Not to mention the hassle of creating new paper wallets when you want to buy back. And in some cases, if you have a large amount of a coin that doesn't have much liquidity, you'd have to spread those sells across time and across many different exchanges. This is not a trivial process. Once again, hedging is how you get around this. Bitcoin futures are incredibly easy to short and also incredibly liquid. Finally, the third reason is if you want to keep some low limit orders on exchanges for different altcoins that you like long term. This is to take advantage of the slippage and flash crashes that occur sometimes. For example, on March 18th, when there was a sort of altcoin capitulation, I was able to get some amazing deals. Enigma for 75 cents, Icon for $1.60, and EOS for less than $4. When I woke up that morning, I was already up 30% on some of those orders. But the problem is that almost all of these altcoins trade exclusively against Bitcoin. And I didn't want to have any Bitcoin exposure because I was convinced that it was going to keep going down further. The solution to this problem? To hedge in the same amounts of your orders, and as your orders get filled, to reduce the hedged position in the same amount. Effectively, you're creating a US dollar pairing to any altcoin that you want, so you don't lose any money if Bitcoin goes down. So now that you know what hedging is and why you would want to do it, let's move on to how you would do it using Bitmex futures. So here I am on the Bitmex testnet, and just because I don't want to use my real Bitmex account. And if you want to sign up for Bitmex to do this, you can use my referral link below. That'll give you 10% off of fees and also send a little bit my way. So you go to sign up, and please note that if you're in the US, it is against their terms of service to have an account, but I've been told that you can get around that using a VPN. So once you have your account, you go to deposit, and you would deposit an amount into your Bitcoin address. So now that you have Bitcoin in your account, so you can see that in this case, I have a little bit under 0.1 Bitcoin. So you go to trade, then you go to the Bitcoin XBT contract, and then you're going to click on, it's going to be set on perpetual at first, and you're going to click on whichever first month this is for their futures contract. Now, the reason you're not going to use the perpetual is because of the funding rate. So Bitmex uses the funding rate to keep the perpetual swap contract tied to spot Bitcoin. And so depending on if you're long or short and there's more longs or shorts total, you're going to end up either paying or receiving a small amount every 8 hours. And so if you don't want to deal with this, then you're just going to use the normal futures contract. And keep in mind that because they are monthly futures, you do have to put this position on again in the next month. But typically, you're not going to be hedging for more than a month at a time. Or if you are going to be actively managing it. So make sure that the amount that you had deposited is at least 1% of the amount that you wanted to hedge against. So you do want to give it more than 1% generally, unless you only think that the market can go up 1%, because you're going to be using leverage. And leverage is when you're borrowing money from the exchange in order to put on a larger position. So at a 10-to-1 leverage, you would be borrowing 9 for every 1 that you have in your account. So what in this case, if the market moves against you 10%, then that full position is liquidated. And this means that because you were leveraged at 10x, at 10%, that's 100% loss. And so any money that you put into that trade is taken by Bitmex. So that sounds scary, but in reality, since you're hedging, that amount would effectively have been made in your other investments. So if you go to, it'll be on the limit order tab originally. And just to make things simpler, I'm going to go to market. This does mean that you pay about 0.75% more fees, but it's not a big deal unless you're putting on a gigantic position. So say I wanted to hedge against $10,000 of my long-term investments. So I'd enter that amount, and then I would sell. It'll give me a warning about this. Make sure that this is set at cross liquidation. This means it'll use your entire account. And then you'll see that the orders were submitted and filled, and you now have an open position here. So in this box, you'll see the liquidation price. This is what I was talking about before, where if Bitcoin moves up to this price, then you're going to have your account, this available balance, will be taken by Bitmex. And consequently, it means that at that point, your investments that you had hedged against had gone up that amount. And then in the opposite case, if you do end up being right about hedging and the investment goes down, then the profits that you make on your short position here is going to make up for the amount that it went down in the other one. And then so when you want to close this hedge later, so say that you had low limit orders on an exchange and those were filled. So if half of them were filled, then you would buy the rest of you would buy this in the same amount. And then if you wanted to close your entire position at once, you can either enter that amount in here, or you can just click on close position here, and that'll close the entire position. And now you are no longer hedged. That brings us to the end of this video. If you have any questions, please leave them in the comments below. I know that the process that I've just outlined might seem a little bit complicated, and I'm happy to answer any questions that you have. We're very good about getting back to anyone that asks questions in the comments. And so I'm also excited to announce that we've started to send out a weekly crypto strategy newsletter. So every single Sunday, I send out a very detailed email with lots of charts, reviewing the price action of the last week, and also detailing the strategy of exactly how I'm approaching the markets in the next one. So if you go to altcoinmentors.com/strategy, you'll be able to sign up. And when you do, you'll get the last week's strategy newsletter in your inbox right away. And the next one will be queued up to be delivered on Sunday morning. If you want to keep up with us during the week, we have a Telegram channel where we post trade ideas, charts, and market updates every single day. So that is altcoinmentors.com/telegram. In there, we have a model portfolio that we started last month. And in the same time, the market as a whole has gone down 2%, but we've been up over 25%. Every single one of the trades that we ourselves are taking are going to be in that model portfolio as well. And so if you want to get that, the link is in our Telegram, or you can just go straight to altcoinmentors.com/portfolio. If you like this video, please make sure to let me know by hitting the like button below. Also, be sure to subscribe to our channel and hit the notify bell to get alerted whenever we post new content. Also, make sure to share this with your fellow crypto investors if you know someone who would especially find this useful. Finally, again, if you have any questions or comments at all, please make sure to leave them in the comments and we'll get to them as soon as we can. Thank you for watching, and I'll see you in the next video.